Fuck you, bipolar bear. Good morning. This is super exciting. Hey there. Hmm. Okay. Yeah, I feel fine. I was up really late. Ugh. When this hits 44.60, buy puts, and when it hits 44.50, buy calls. Gross. Or just don't trade it at all, because it's shitty chop. Did you see the Jimmy OPEX move this morning? It was wild. We moved up a whole 39 cents. Yeah, I see it went crazy. Woo! Just because he shows up at 10:30 doesn't mean something is wrong. Would you like to hang out with us? I'm in. I'm here. You see that they reg showed XRT? No. But that fucking sucks. That's never a good sign. Yeah, it's been a while. Did they do that last night? Fuck me. What does reg show for XRT mean? Usually means we're not running. God, yeah, it's been like a year since they haven't reg showed they literally haven't reg showed XRT since like last September. Don't we usually run when XRT comes off reg show? Yeah. Does Fubo kind of lag rut price action a bit? It's pretty sensitive to index moves. Who wants to help me lift something heavy in Virginia? Huh. At least something's happening. Yeah, that's not really the thing I'd want to hear that's happening, though. Does that mean failures being closed in sequential order are back on the table next month? If the market's still around by then. It's not my bags. Okay, that was important to clarify. Any other recent memes they could be using XRT to stabilize? Uh, what the fuck is still in XRT? Sure. Express, maybe? Macy's? Bring it to California and I'll help you lift it. I can't remember what happens when GME, like XRT goes on Reg Show. It's literally been a year. I think it means nothing, right? So I can just full port covered calls and not give a shit. Well, I can't, right? But that means because there'll be ETF FTDs. Gross. Are you guys sure it went on? Because XRT's not even like that illiquid right now. I'm gonna double check this shit. Motherfucker. Ooh, WeWork is on a Reg Show. Be fair. Huh. Just reverse split it and it's on Reg Show? Or was it on Reg Show when they reverse split it? Yeah, I guess it doesn't matter. What's up with T? T's ripping. A Reg Show doesn't necessarily, just because it's on Reg Show doesn't mean anything's going to happen. It's just kind of interesting that it's on Reg Show after the reverse split. They used to Reg Show XRT to make it so that the ETF FTDs don't overload the capacity to clear them and make them have to resort to actually buying the underlying, right? Yeah, but there's no increase in GME's borrow rate today, is there? Well, they borrowed a lot of shares against GME today. Yesterday it hit 1.1 million intraday, and today it's down to 6,000. Fidelity's shares to borrow are down by half. Huh. Ooh, Siri's borrow rate's moving up. Interesting. What's Siri doing today? Also going up? Did Carl do ETF FTDs for GME? Today's 9/20. There's like none. Beginning of October. Not a lot. There's 1.2 and 1.4 million on October 13th and 16th. That's kind of high. Gross. I have Series 8Cs that need picked up. XRT on Reg Show. Yeah, I think it. Well, not necessarily Thanksgiving, but I think it means Jimmy will get a dollar spike in PM slightly above average volume for 60 to 90 days from now. Why do we assume XRT going on Reg Show has anything to do with GME, though? It may not, but it usually does. Off topic, what happens with the drip when the dividend amount isn't enough to buy new shares? You buy partial shares. Gork, Raging Cajun Potato Skin, how is there possibly a 99% chance of no hike? Like, not even 5 or 10% chance he might. So that's not what the CME FedWatch measures. The CME FedWatch measures what the Fed fund futures are pricing in. The Fed fund futures are pricing in a 99% chance that the federal funds rate stays at 5.25 to 5.5% for the next 30 days. Is a gap fill likely before FOMC? We could, I suppose. I don't know if they want it dropping that low, but I guess we could. I feel like defending 4450 is kind of important. And right now they have it. But we do have quite a lot of time, and there's still more. I guess the only reason we would is because there's still more puts on the chain than there are calls. Slightly. Calls have picked up a lot, though. So the call side's a little more fleshed out today than it was. Could we slide under 50? Probably not. Just remember that after the decision, whatever it is, and whatever the dot plot shows, they're probably going to want to grab all their calls. So don't be surprised, even if it's hawkish as fuck, if we get a small bounce, like 75-ish range. I'm not sure we'd go much above that, but we could. I know I tried to warn everybody in the write-up last night, but I'll do it 50 more times before 2 o'clock today. When are you planning to sell GMECCs if it doesn't run? I don't know. I guess I'll see if like the Fed minutes drive any price action. And then if it's like I'd prefer to sell them closer to 18 or 1850 than selling them at fucking 17. Selling them at 17 really sucks. Express still has no options. Really? It's been a while. That's surprising. Vol's picking up a little bit. Is the dollar fucking bouncing back yet? No. Yields are still tightening. Nothing crazy, though. Ooh. China might start selling treasuries. Or China might be selling treasuries right now, actually. VIX is ticking up. Yeah, I guess we could drop a little bit here. I don't know if it'll be enough to fill the gap, but we could drop a little. I think most of that's just that, like, on low volume, we're gonna kind of still drift down a little. And there is not a lot of volume. What's Tesla doing today? Being a cunt, of course. Apple, that's not so bad. At least that's down. Netflix is down. Video's down. So tech's not really doing particularly well. What's Google? Google down. Ooh, Google's getting hammered. Microsoft down. All right, so nothing in tech is running hard. What's RSP doing? Oh. RSP's floating the market. Up 57 BPS this morning. NQ's still down for today. Interesting. That's interesting. So oil's down. Oil tech are down. RSP up. So Dow and Russell are doing pretty well. Small and mid cap. Huh. All right. Sorry, I just gotta kind of review all the shit that I normally do in the morning because I was asleep. England was slightly better inflation. A bunch of EU speakers and their construction output improved. 30-year mortgage rates up. Refinancing's up. Mortgage applications are up. We got a 17-week bill auction at 11:30, and that's about it. Since you said 0 DTE is late and has and would be volatile in Pickles picks, are 1 DTE SPX worth it this afternoon? I mean, you can play the volatility with 0 DTEs, but don't try to play a direction with them, because after the Fed minutes drop, like, and through Jpow's speech, none of the price action is confirming, right? So, like, if we go up to 44.75 as, like, right after the dot plot drops, that's not confirming upside, right? It can just as easily drop back to, like, 44.30. They're gonna pull back neutral positioning probably for the remainder of the day because there's a shitload of it. And so you can't really trust any of the price action once the data starts coming out and once the Fed speech starts, like once the presser begins. So having, yeah, I mean, even having 1 DTE is probably significantly safer if you're trying to pick a direction. But I mean, like, I'm straddled right now. Like, I'm gonna try to play both sides of them pulling back their neutral positioning. But then I'm not I'm not really going to try to pick a direction into the end of the day. I'm just going to place another straddle, right? And then see how the market, quote unquote, digests the data going into the end of the week. I bought a grip of $10, $20, $9 calls on what? What's the usual margin requirement for a condor? That's the combination of the two spreads. So if you have two $5 spreads, it's 1,000. If you have two $25 spreads, it's more. I was thinking strangle $10, $20 wide. Yeah, you can do strangles. They're a little cheaper. I mean, vol's not very high, so they're not super attractive, but would they still be able to grab their calls if he hikes? I mean, they could still try. Keeping prices to the upside of 44.50 makes it easier for them to do that should things go south. So overnight, Tesla call interest, like last night, Tesla call interest picked up a little, but bought call delta is still negative. A little bit of short dated call positioning fell off. A little bit of longer dated put positioning picked up. Gamma's still positive, and dealer delta is still negative. So chop. Tesla still looks really fucking choppy. When does the party start? Are you buying Pooty Toots? I have a straddle. I might buy a strangle also, like a zero DTE strangle. Oil's recovering. It's starting to. It's back above 90. I don't expect it to stay down for very long. Any changes in top overnight? No, but it's running out of liquidity pretty quickly today. Might be out now. So we'll see how high it runs once they run out of liquidity and they need to start buying the underlying. If Jimmy had some fucking volume, maybe things would be moving. Oh man, they did not get a lot of liquidity on GME today at all. I feel like that should be kind of bullish. Very little. Hmm. Dark pool dumps? Look at this. That's like the least liquidity they've had at market open since ever? Yeah. June 8th? June 8th was pretty low, but still way more than this. June 8th was 7-3. Get the a few orders of magnitude less. Hmm. Interesting. Are you gonna pump it? I want them to pump it so bad. They shorted hard after earnings. I wish people still bought options on GameStop. Those days were really cool. When we had like calls on the chain and people were like making the market maker buy shares with leverage. Oh well. I wish RC never split the stock. That would have been cool too, yeah. But think how many DRS accounts would only have one share instead of 4. Options are bad. Don't you read the latest DD? Options are the only reason GME ever had any fucking price improvement. If nobody bought options on GME, Gabe would have won. That's on NVIDIA to 400 today. Why are you fucking trying to target NVIDIA 400? It's trading at 434. Do you have weekly 400s on NVIDIA? Didn't we go over this Monday? I was pretty specific on Monday that I could take several weeks for it to even break down to the lower trend, which is not at 400. It's at like 405 ish. Oh, Wall Street Bets ban hurt GME options. There was like fucking GME DD on the front page of Wall Street Bets like 2 days ago. Or it wasn't really DD, but there were like GME YOLOs. Just asking every day for a laugh. Okay. Yeah. So you're totally not overexposed to NVIDIA 400Ps? All right. Powell, pause, rally. I mean, a pause isn't bullish. The market's reaction to anything the Fed does is not deterministic of forward price action. They're just going to like Powell's going to like they're going to put out the information in the dot plot, and then Powell's going to make a speech, and while all that is going on, they're going to pull back all of their puts and their calls. It's not even short-term bullish. They're just going to pull back their calls, which go all the way up to like 44.75, and they're going to pull back their puts, which go down to like 44.35. Yeah. This is what happens at every FOMC meeting. It's the same fucking shit. So wherever we end the day will be the side of the pile that has more open interest left after the initial breakdown of the straddles. Yeah, you could strangle it. Straddles are arguably a little bit better because you don't need as large a move, but and vol isn't very high. So unless Powell does something crazy, like 0.5, that's probably what's going to happen. Will DVN do something interesting when the commodity super soaker finally squirts? Because it's been a wet blanket since going over 54. I mean, DVN will do something when profits are recorded from oil prices being elevated. Most of the reason DVN went down is people were dissatisfied with the amount of money that they made the last time that oil was expensive. Can the market trade between 4,400 and 4,600 forever? Stagflation? No, eventually. If it were confirmed to be in a stagflationary environment, the equity prices would tumble. Then we'd trade flat. First time FOMC gambler here. What's the best position for the straddle? When's best a position for the straddle? I mean, if you can buy like 4450s out of the money, that's always good. Why are we watching top? I want to see if it's going to run. Is it gonna run? Well, they're kind of out of liquidity, so it could. I had the runs. We aren't watching me. Well, nobody was selling options on you having the runs. I'm curious. I'm starting to really like spreads. I protected my Tesla puts overnight and sold at the 268 test, bought more puts, and lowered my cost per contract. Well done. Maybe you'll ask me less questions about Tesla today now. I think BTU's statement on climate change on their website could be a part of a stand-up routine. Interesting. I haven't seen it. You'll have to send it to me. I just snagged 4x October 18 calls on GME. It's been a long time since I played an OPEX. I hope I didn't curse it. It couldn't be any worse than it currently is. Thoughts on Tesla? It's just chopping. There's not a lot of change in like open interest since yesterday. You plan to straddle for the FOMC. Would one DTE make sense to avoid theta decay and still be exposed to the move? Oh, you don't want that. That's not ideal. Um, the more theta you buy on the straddle, the greater move you need in order for it to print. It's much better to be exposed to the gamma on the like the 0 DTE straddles. Or if you're gonna do that, be prepared to carry it for a couple days till like more price action is determined. I'm cool as long as you rip 2% or drop 2%. I won't accept anything less than that. I mean, VIX, where it currently is, would indicate that you'll probably get something less than that. I found this bit hilarious. Peabody is already taking direct actions to reduce emissions from our mining operations. Think how the mining of coal is done with carbon conscious approach. Well, they also mine the fancy coal for steel, the metallurgic coal. And that's cleaner burning. Coal plus. Why did RC move the FOMC to the day of GME's September OPEX? We never catch a break. I don't know. They're contracting on the 1 hour. I wonder if that move made a difference. Ooh, a little bit. So that was like a little bit of covering. Still mostly in line with like the last 3 days though. Hmm. TRS buy-in. I wouldn't. I mean, they put XRT on Reg Show last night. I probably wouldn't be going along GME right now. I think generally speaking, when they put XRT on Reg Show, we don't run. So, any thought on 15p for Palantir? What expiration? Palantir stopped making money again last quarter. So things could only get worse, right? Like 2 DTE to play downside for FOMC? It has a lot of support at 14, but I guess you could try. Yeah, it's not impossible. My other daddy, other than you, Donald Trump cleaned all the coals, so now we burn 100% carbon emission free clean coal, and West Virginia is the center of green energy production. Huh. I know it's FOMC day, but repeat failures of 44.55 above this gap make me think that it'll drop at least a little. So I think that ideally bulls would prefer the price going into the FOMC meeting is above 44.50. Probably way above 44.50, but I think they'd like some padding there. You think GME won't run because of XRT FTDs? No, I'm thinking GME won't run because they put XRT on Reg Show, and now they're going to use XRT to short the fuck out of it. Is Jimmy is gonna run today because I have to travel for work. I had to travel last August when Bobby ran and watch my account drop 280K during a flight. I'm ready to be hurt by Jimmy this time. Good luck, Pickles. Thank you so much, Tegrity. You know that in-flight Wi-Fi is probably sufficient to execute an order on, right? They're poor because they full ported coal? Couldn't the shorts let Jimmy run and then short it hard? Why would they do that? Kirk, he's already dead. I wasn't trying to kill him. Australia could be the same in the future. Full ported into commodities. This is the type of commentary I'm here for. I think about selling $4, $3.50 or $4 calls on Fubo for November 17. Current delta's 3827. If SPX drops, I'm thinking it'll drag Fubo for a bit. My cost basis is 2. I mean, do you care about assignment? If you don't care about assignment, then what do you... the only problem I see with November is it's a little far out, right? Like you're selling out past the next earnings call, or well, maybe. I don't actually know when Fubo's next earnings call is, but I'd imagine it'd be sometime in November. I'm sure they haven't probably announced the exact date yet. You saved $8 by not paying the ludicrous price for simple Wi-Fi. They didn't have the Bernoulli equation, much less plans, the last time GME ran. There's no way people are rotating from tech to value bigly today. I mean, a little bit. There's like a little sector rotation going on, but it's not. I would argue that they're not plowing their money into a whole lot of value, poopy pants. But yeah, the market's largely being propped on the back of like RSP. Why is GME even profitable for shorting anymore? I mean, they shorted it when it hit 27. So that's that's every share and every synthetic share short plus any like naked calls and bought puts all $10, $11 in the money at the bottom. Seems valuable. I'd do it. If something was gonna just drop $10, I'd short the fuck out of it, right? Especially if you're the one that can make it drop $10. Imagine on top of that, you're an institution and you know exactly how many shareholders there are, the rate at which they buy, and that they are not going to sell their shares, right? And so with that information, you can very easily model risk in the position. And that allows you to over leverage even harder. I wonder who would give them information like that. Hmm. Just like perfect data on every single shareholder's holdings. So you had a constant view of the exact liquidity pool at any given time. I wonder if there'd be like a company out there that like registered shares, but also then took that share registry data and sold it to institutions to make a profit, like cookies on a website. Not computer chair, that's for sure. They would need computers to share all that data. They might. Who would lie to first time stock buyers? Not somebody who made fees off of them. That's for sure. This kind of sharing of information could be computerized. I have an idea for a name for this kind of company. I would call it computerized sharing. Hmm. You need to shorten that. Could you? Maybe even just abbreviate it to its first two initials. I wonder who would buy that information. That's crazy talk, Kirk. Wall Street seems pretty above board. This sounds like a conspiracy theory. Really? ComputerShare makes money according to their earnings off of selling data. I wonder what data they're selling. Anyone that bought that information would be a fortress. Hello, I'm calling you about your car's extended warranty. Thank you. Hey, Fubo's having kind of a fun day today. Russell's up. That's neato. The man tweeted a picture of a computer on a toilet. Does that not convince you that your shares are worth $10 million? The opposite, in fact. At least direct registering to computer share didn't actually cost GME money every time someone registered their 3 shares. Yeah, they totally don't have to pay for every open account. What about the people that split their 2 shares into like one infinity pool share and one share to sell on the way up? I'm sorry, on the way down. Can you give us your FOMC expectations? I think he'll pause because he's a fucking big cuck. Um, and then I think the dot plot projection is going to be super fucking hawkish. And he's kind of going to give the market a month to get their shit together before he starts pounding them in the ass with more rate hikes. Time to cleanse, if you will. How much damage will a pause cause? Probably about as much as it did last time. I wouldn't be surprised if we see like, especially if oil continues up. I wouldn't be surprised if we see like 5-6% inflation by the end of the year or Jan. Houston Wade plans to sell his first share in the 6 digits and one more every other 1,000. Don't remind me. Why would you? Why? Give me a second. Let's see if I can. Is that 50? Are we there? Okay. I need to pick up my 0 GTE straddle. Give the market time to get it together before he does nothing again. Oh no! I mean, there's still going to be another rate increase this year. I think maybe the question is how much of a rate increase. But the current dot plot projects 5.6 is the terminal rate. I think this will move it higher. So they're still going to do something this year. Explain the dot plot. It's like a representation of where each Fed member thinks the federal funds rate will be at certain points in time. So right now it's like projected more than half of the members believe that the federal funds rate by the end of this year will be 5.6 to, or well, 5.25 to 6%. Right now it's 5.33. Jpow Jpow has a unique opportunity today to shock the markets if he wants to. I just don't think he will. I don't think he has the cojones. Where do you think the whipsaw might have its top and bottom? The majority of strangle positionings, like 44.75 and 44.35. So if we presume that the straddle positioning is all going to be at 44.50, which it currently is, you know, we could do that or the other way. Although I think the bull side first, but it doesn't matter if you're neutrally positioned. Hey Greg, do you think there's no hike or 0.25 hike are both priced into the market? No hike is priced into the market. Not only is no hike priced into the market, there's literally no disagreement on that point. The CME Fed Fund futures is assuming a 99% chance that there will be no hike. So if there is a hike, it would be a surprise, and that would have to be priced in. What do you think about shorting XLY or play? Since consumer is getting pounded by credit card debt, student debt repayments restarting, underwater car loans. Why Dave and Buster's? You think that's where people are going to stop spending money first? Like, of all the places where consumer discretionary money is spent, you've chosen Dave and Buster's? How's top liquidity? Dog shit. Why did he have the cojones last year but not this year? Well, he hasn't had the cojones this year because the banks ripped them off of him and they keep him in a little jar on Jamie Dimon's desk. And that happened in March. So ideally with a straddle, wait for one leg to double. Well, you may not get double, but you want to get as much as you can. I've played a lot of FOMC meetings, and very rarely do you get a move to one side that's sufficient for one leg to 100%. Jpow's not responsible for Volmageddon. Not in the slightest. Was there any positioning changes that made SPX 4450 less likely to be the price right until FOMC data? No, no. 4450 is still the most likely price for us to gravitate towards. If we move to the upside of it, people are going to buy 4450 puts. If we move to the downside of it, people are going to buy 4450 calls. If Powell does hike 25 BPS just straight down, no, they'll still pull back their fucking calls probably and try to pump to de-risk 4450. The 4450 and now 4435 both have a lot of Vega risk. They sold the 4435 yesterday and the 15 really heavily in order to get that like mid-afternoon pump that we got where we moved back up and retested 4450. So now there's more Vega risk to the downside. So they took on a lot of risk, assuming that the outcome of this meeting is going to be pretty neutral. And even if the outcome of this meeting is neutral, it's still not bullish. Like nothing changes. There's still not a lot of upside liquidity. Probably just means we float in the like 4450 to 4500 range for another fucking 3 weeks. I don't think that the put that you own Lawrence of Arabia is going to influence the decision of the FOMC committee. I don't think their closed door meeting is them just watching your brokerage account and being like, I don't know if he's gonna keep or sell this put. When I'm poor and sad, I go to Dave and Buster's. I mean, there's no place else that will babysit your children while you get drunk, and I think that alone provides some value. I don't know. Dave and Buster's creep me out. I don't like going there. I actually don't like hanging out at any place where adults are drunk around children. Do you think both sides of your straddle will print? Yeah. There's nothing bullish about them stopping rate hikes, though. There's nothing bullish about them cutting rates. A pause is just a delay in the inevitable. Yeah. I mean, Jpow really needs. I don't know how aware he is, but he needs to. I'm sure he is moderately aware. He needs to kill the wealth effect. Everyone in the country, mostly, feels really good about where they are financially right now with their 8% mortgage and their moderately high paying jobs. Um, and he needs to stab that a bunch. He needs to make them sad and depressed. He needs to take away their jobs. He needs to force them to go back to offices because that drives a huge sector of our economy that's just been dead in the water ever since work from home began. And he needs to make them beholden to their employers like the serfs they are. Now, if he can do that, America can keep doing what it's done for the last 50 years for a little while longer until our government shuts down in 2 weeks. So once SPX hits 44.75, I'll go balls deep in puts. If I don't make money, I'll ask you to refund me. Thank you. Have a nice day. I hope you lose everything. Jesus Christ, I mean, you aren't wrong, but that's heavy. It's true, right? That's what they're trying to do. That's people just aren't listening. So they have to keep doing it longer, but not harder. He's a gentle lover. 10% mortgage feels good, man. How do you feel about iron butterflies at 44.50? Risky. Inverse? Inverse not so bad. Assuming that we're just going to end the day at 44.50 is bold. It could happen, but it's a pretty that's a pretty hot take. I don't need your hope. I lose money on my own. If levels don't matter after 2 p.m., better to set 20% trailing stop once a 0 DTE leg is green. I mean, you'd ideally you want to sell both. when they're green, not sell both when they're one's red, because that reduces your potential yield. But you could. I mean, it's an option. It's just you'll make less money. It's easier to manage. SPX doesn't have volume. Can you take a second to explain how much extra cash is spent with an 8% versus 3% mortgage? Thank you kindly. The cost of finance over 30 years is a little more than double the initial purchase price. A pretty flippant take on the well-being of hundreds of millions of people. It's just accurate. I'm sorry you don't like it, but it's the truth. Poor people need to be doing poor people things and tightening the belt, and they're not. I'm all for workers' rights and higher wages, and I think the way we're going about getting them is not healthy, though. And since they're only being paid for on the back of corporate profiteering due to high inflation, it's also probably not sustainable either. There has to be destruction of wealth, and the way we're going about it is not doing that. T's kind of ripping. It's doing pretty good today. I'm happy. It's back above my cost basis. I think the biggest problem today is that boots don't come with bootstraps anymore, so we have nothing to pull ourselves up by. I tried to tell my poor sister to stay in her lane, but she's insisting that buying a home at 7% is a solid move. Then keeping up with the Joneses mindset is disturbing. Well, it's incentivized through all of our media and social media, right? We're taught that. I mean, in almost every facet of American culture, we're taught that having stuff and things is the most important thing. That equals happiness. Was renting at 2,500 really much better? I mean, yes. I'd much rather spend. I pay $3,500 a month for rent, and I'd much rather spend $3,500 a month than 5 grand to needle away at equity in a fucking $300,000 home that I bought at the top of the market. Also, I don't have any maintenance or repair costs. Shit goes wrong, it's the landlord's problem, not mine. Anyone with substantial wealth can park it in treasuries for 5% risk-free. Yep. But that takes money out of the economy, right? When you park money in treasuries for an extended period of time, that money is not being exchanged. And so it slows down the rate of velocity in the M2 money supply, which ultimately causes wealth destruction. So it's yeah. Unfortunately, a lot of people with tons of money aren't parking their money in treasuries. You have a better way to achieve happiness? Spill? I don't know. I don't really I mean, like I buy a lot of like kitchen bullshit, but I don't really I'm not like excessively materialistic. I think I'm pretty happy. Although my definition of happiness is probably a lot like I'm happy if I can wake up every day have internet and look at the stock market. I don't think that works for most people. The mold was your problem. I mean, it wasn't. I just moved, right? The mold would have been a problem if I owned the fucking place and I had to remediate all of it. I do own a house, but it's outright. I don't I don't have any, like, I have 100% equity in it. And that equity is 10x what I ended up paying for it, right? I still can't sell it yet because of fucking capital gains, but hopefully the market won't have fully crashed by the time I can, or it'll be recovering. Happiness begins and ends at the Disco Biscuits. Isn't real inflation much higher than what's reported? Like, earning 5% in treasuries on a large sum of money, you're still losing money. I mean, it depends on the rate of inflation, but not necessarily, right? 5% is 3% over the estimated rate of inflation in the longer run. But yeah, the premium or the yield premium should be higher to incentivize people, because a 3% spread isn't phenomenal. And would it make you happy to skip through a species-rich meadow with me? I'm allergic to almost everything on the planet. Why would that make me happy? Predatory lender? No, I'm not. I said my average monthly expenses are 10 to 15,000. I did not say they were 25,000. That's because I didn't count going out and stuff. I spend money on some things, but that's not materialistic. Those are experiences, right? Not items or durables. Money buys happiness, not stuff. Money just reduces stress, or well, it reduces stress in some areas, so you can stress out more about other things that are, less important. I've been very good. I've reduced my DoorDash budget every month in line with economic conditions. I was spending like 4 grand a month on DoorDash, and now I've got it down under 1,000. I simply get up off my ass and walk places, which is probably better anyway. No, I'm not tipping less. I know it's a waste of money. If I bought 4 contracts in one trade and sell them at a profit the same day, is that one day trade or four? It's one if you sell and buy them. Like, if you buy them all together and sell them all together, it's just one. I just quit eating. Nice. Terabang. Thanks, Bull Bear Pig. You have a crazy skewed view on America? I don't think so. I think you're out of touch. Opinions are like assholes, Middle Western consumer sentiment. We all have one. Some of them are cleaned with bidets. Some of them are simply wiped. Okay, we're not getting into that conversation. It gets too weird. If I'm out of touch, would you share some of your touch with me? Nah. Oh, poopy pants, you were right. I should have just woken up at 1:30. $4K on DoorDash isn't that hard to spend, especially for NYC. Yeah, it's not. That's like less than a meal and a half at like less than a meal and a half a day on there. Unless you're I mean even if you're eating like shit food, like Five Guys or something, it's like fucking $80 for like a burger, shake, tip, and fees. Fries. How much do you usually tip? I usually just tip 20% for shit. I don't tip for stupid things, and I don't tip for fucking like counter service, but um I tip for pretty much everything else. $80 for a meal? What? You are the inflation? I mean, that's what it costs, right? What am I gonna do? It's not that much cheaper to fucking buy food and make it at home either. You just get more quantity. Like, but you still spend about the same amount of money. How rich do you have to be to follow the first rule of being rich? Don't spend your own money. Well, that has more to do with business ventures. Out of touch and coping. Where do you live, Al? Quantity is the American way. What are you? Some kind of non-patriot? Euro poor? So you spend 40% on taxes. Your inflation's almost as high. And you have a significant amount of social safety nets in place. What's so terrible about being in Europe? I remember one time you tipped $400 for a coffee. That was an accident. I didn't mean to do that. I just forgot to put a period on the fucking app. I wasn't gonna, like, take it back. Looking at US salaries is the worst thing. Why? Because they're higher? Or isn't that just relative, though? If our cost of living is higher. Just remember that we have to pay for all our health care out of pocket. Roscoe's chicken and waffles, pretty good. Yeah. Probably worth it. You feeling like having chicken and waffles? Don't employers pay almost all of it? Only if you have enough money to actually afford it on your own. Otherwise, no. Most employers in America do everything in their power to not pay for healthcare. I would say the vast majority of employed people in America do not receive healthcare as part of their pay structure. Oh, don't go to the one in fucking Anaheim. That's it's not as good. It's gonna taint your experience. Go to Compton. It's fine during the day. You're not gonna get hurt. 54.5% receive coverage with work. That's way lower than I thought it would be. That's for salaried employees and doesn't count independent contractors, which make up like 20 to 30% of the employment pool too. So that number's even slightly too high. I made the mistake of complaining about my salary to my much older coworker. I think they're only making slightly more than me, despite being 20 years my senior. Whoops. I ran out of gas in Compton. Don't do this. It's bad for your car. What kind of time frame could we be looking at to push up? Hold on. Fuck. Slept on my fucking neck weird. Ow. Alright. Push up for de-risking after a hawkish. Hawkish, not bearish. Hawkish FOMC. The rest of the day. No, it's an NW. What happened to Middle Western consumer sentiment rep? I was hoping for a spicy debate to break the boredom on how I'm so out of touch with the average American. Disappointed. I was reading like a cultured serf. Listen, this is the government you voted for, right? This is what you get. If you think they're working in your best interests and not the best interests of the wealthy, you're wrong. How shall I vote next time? I mean, do you want a way that'll work? I heard that voting with guillotines tends to be pretty effective. Everyone like the stream now before you lose the chance. Don't you even start with that flat tax bullshit? No, just tax the fuck out of anybody with money. The more money you have, the more taxes you pay. It's easy, right? That's how it should work. But then more money for spending on Ukraine. It's a good investment. Do you have a problem with our government spending money on Ukraine? Do you understand how economics work? You know they're going to pay us back, right? And the price will be the very essence of their country and economy for the next 50 years. Well, that's why it's important that we keep giving them goodies, Blueberry Batman. Whatever. Trickle down, Bob. Larry Fink's gonna trickle down all that wealth all over you. $4,400 to $4,500? That seems a bit excessive, Larry. I would say 44.75 to 44.35 seems more probable. Marshall Plan in Europe was how America became number one. Yep. Although, to be fair, Europe would be like number 50 if the Marshall Plan didn't exist instead of like number 4. Or just part of the Soviet Union. Still number 50, actually. Yeah, no, same outcome. Thanks for the great info. I doubled my port test from Disney puts. Have you done any research on their outlook in the near future? Bearish, bullish? I don't like the outlook for Disney for the next year or so. I've been pretty bearish on them for a while now. I'm not playing them. I don't have any particular interest in it. It's just yeah, I don't think they have a lot of direction right now, and I think they need to find some. The streaming services clearly aren't it. Just don't do it like the UK. I had a client who worked for a UK startup and was going to get a payout in stock. So actually asked me not to rent out her condo as she'd have 100% tax on the additional money. Yeah, that might be excessive. I just learned something. I think it's super important for everyone to know before the data this afternoon. Did you know that the Fed is a bank? Fucker. I should have read that one in advance. Just watched a video that pretty much showed that Taylor Swift's last tour is the root cause of inflation. Jpow raising 0.5. That'd be very good for our economy if he did. Long term. He won't, probably. Are you gonna play Payday 3? Is that the game where you like rob banks? The ideological repeat on Ukraine is a lack of knowledge and following of rhetoric. On my part? Please expand on this. $27 months ago, I didn't know that the Fed was a bank. Well, now you do. What makes you think that 44.75 is the top of today's range? I didn't say it's like a hard top. That's just where the majority of like interest out of the money is. There's also put walls above that. I don't think they meant mainstream media in general. Okay. Last I checked, mainstream media wasn't talking about the big economic boon from rebuilding the Ukraine after we fund their war with their government bonds. But usually the mainstream media is not so dark. And then isn't like half of our mainstream media like pro Putin, which is insanely odd to me. Like why do we have pro Russia simps in the US? How the fuck did that come about? Not on your part. Senate guy here. The complaints on why we're Ukraine aid is the issue. It's rhetoric that I've even pushed myself as my job. Oh, yeah, yeah. I don't think a lot of people understand the importance of Ukraine, not only regionally but in the world economy. Brain damage from long COVID. Fascism fanboys. Propaganda, maybe. Oh, yeah, okay. I mean, it's a proxy war. You shouldn't be rooting for the other guy if you live here. Did you hear about the New York City daycare Fent ring? Yeah, they're gonna start losing their government funding soon, so it would make sense that they're opening up other revenue streams. Or what if you don't want any war because we just got out of a 20-year one with nothing? Bob, from what I know of you, I think you wouldn't mind one of the civil variety. Otherwise, what did you stockpile all those guns for? It's not a proxy war when the main antagonist is mired in the fight itself, and the other big player isn't taking any part. Yes, it is. Well, a little bit. Like half, all right, fine. Half proxy. Sorry I've covered, but thoughts on top run potential? Any changes you've seen? Thanks, boss. No, liquidity's pretty dry going into the end of the day here. If there's a need for covering or more volume, it'll probably have to be in the underlying. So it can run. I don't have like huge expectations for it or anything, but it'd be cool if it hit like $2. What? Disney isn't going to recover? 2 years of people freaking out about virus and germs, and now people don't want to return to Disneyland? A square mile of every disease known by the CDC? Shockingly, people just don't want to go to Florida. And California is too expensive. Is FOMC going to cause movement of the Bippies? Biplies? Yeah, I would imagine. Check out the Newsweek article that just came out titled, "We Can No Longer Hide the Truth About the Russia-Ukraine War." What truth were they hiding? There's a lot of contradictions in fascism. It's it's not something that's generally brought about by forethought, Baradactyl, or critical thinking. My dad has gone from hating 45 to hating 46 and spouting pro-Russian things and calling Americans Nazis. Well, at least I know that you're fully exposed to all of the middle Western consumer sentiment. How are you hedging 4400p, 4425p, 1020 since they're out of the money? I sold some calls, puts against them. 3 to 5 day call spreads don't seem worth it. I think I have more than. No, I have about 3 days left on the 4,000 spread, and 4425. Think I think the sold put expires today. I'm not looking at it right now. Sorry. July 5th, 2018, Republican members of Congress celebrated the 4th of July in Russia. 8 members of Congress. I mean, you guys, well, probably not you guys, but that's who people elect. When do you think the market will become more interesting again, since it's been pretty flat for quite some time now? Has it? I don't think it's been that flat. We bounced out of the end of August. We've been kind of drifting down ever since that peaked. I wanted to vacation in Florida last year, spend lots of money and time there, etc. Have since changed my mind and looking for other places to go. It looks like more of a dumpster than usual. I don't know. Has it really changed that much? Florida's always kind of just been a shithole. Would be cool if people would just start electing smart people with minimal ambition, which necessarily precludes them running for office from both parties. Hmm. Those people are going to be way too moderate. It's how are you supposed to drive? How are you supposed to drive? You know, division in your voting base if you can't if you're just constantly putting moderate people in office. That doesn't that doesn't make any sense. What would you speculate would happen to Ford stock if they were announced they were licensing Tesla's FSD, the charging system? Would that cause a short-term pop for Ford? Probably not. The auto driving? There is no fucking auto driving. Full self-driving, same like really good at just running over some pedestrians. Now you're just going after my entire industry of creating political division. I'm sorry. Regardless if it works or not, I think Ford would try and use it as good news. Okay. What about all their workers that are striking? How much of a portfolio would you sacrifice to bribe Jpow to hike 0.5? None? I don't care what he does. And if he doesn't hike, I can just buy more long dated puts, right? Why would I give him that money? Why would I give him my put money? Tesla selling FSD, same like me selling Tesla calls above $300. Jpow speech is at 2:30. I'm bored, and that was the first hypothetical I thought of. And yes, I did pre-order one for $100 years ago. I have a friend who works in the C-suite at a marketing company focused in the car industry, and he was actually concerned last time I spoke to him. I mean, depending on the length of the strike, it could be a very big deal. Do you think folks could read the economic calendar that's referenced every week after 2 years? No. Silly. If Disney bought Fubo, would both drop? Well, I'd imagine Fubo would probably go up. Work at the city of Detroit and let them know they gotta last 3 months. He thinks the smart dealers will be stocking up on used cars potentially. They're overpriced though. That's kind of the Carvana issue, right? Is that's like stocking up on depreciating assets that have the potential to depreciate very, very quickly moving forward because they're currently overpriced is very risky. If I was a car dealer, I wouldn't have any used car fucking inventory at all. Unless people were willing to trade it in for pennies on the dollar. Which you'd be surprised. A lot of people really, really don't know or care. Is rolling Tim puts in and down to capture profits crazy? Better to just sell and reposition after the meeting. I don't know. How in the money are you? Yeah, T's recovering a bit. The whole telecom sector is wildly overshorted right now, so it makes sense that as people seek more defensive investments, that they would be turning towards utilities and telecom. And since there's a lot of shorts there, those shorts are going to get pushed out. Probably slowly, but didn't I post a thing about that the other day? Did no one see that? Why was telecom shorted? I mean, most recently because of the whole lead cable debacle. Went up to $7. T+2 from SP 500 listing a thing, or would it just be people closing options the day it lists? Maybe it's T5 because of ETFs. It's probably a combination of like 3, 5, and 13. I know what TUP's doing. They just shorted the whole telecom sector on that lead stuff. Yeah, also telecom's like utility adjacent, right? So, and utilities have been getting shorted really hard. Do you think dot plot outcome is going to cause a drop significant enough to make BTU and other commodity adjacents pop? I mean, they don't have like completely negative beta. They have some negative beta. Never mind the lead pipes for everyone's water. Yes, the telecom lines are more dangerous. Well, what if someone were to dig one up? Did we hit the docu low? No, but it is close to one of my buy-in targets. I hope it drops under 40 by October 20th. Well, actually, I don't care. I guess if I get assigned, it's whatever. Oh, let's go top. But I don't think Jpow is gonna raise. How does that make me smarter than Wall Street Barrows? I just think he should. I don't think he's going to. I want to be clear. I do not have an expectation for him to raise rates today. He should raise rates. It's absolutely in the best interest of the Fed's goals and our economic stability over the next 2 years. But that doesn't mean he's going to do it. He should have raised rates in June, too, when he paused last time before letting fucking inflation heat up again. Are we going to break even on our calls? I'd like to do slightly better than that. How do you think the market will react to a hawkish pause? I mean, today, volatility. Into next week, it depends on how hawkish. End of this week, next week. Talk to a securities lawyer, Fred technician. Depend on. It could depend on what information you're privy to. Why done IV crush on 0 DTEs occur usually? When? Why done IV crush on 0 DTEs occur usually when? IV crush doesn't usually occur on 0 DTs because it stays elevated through the presser. And then at that point they're so close to expiration that IV is just increasing. I would say that 0 DTE IV is not even that substantial yet. But yeah, it usually doesn't crush same day. Yeah, it's alright. Would you consider getting back into HCP? Yeah, I like their business. It's a little bit below my initial buy-in range. I might wait for a lower price now than previously, but I do think they're a pretty good business, and I think they have the opportunity to become competitive in the SaaS field. So yeah, I'd probably consider buying back into them at some point. Not right now. I'm not really interested in picking up tech or services right now. Does AJ always ask us many questions? Usually I don't have the chat open. Usually he spends most of his day trying to find roundabout ways to ask me if it's safe to sell spreads at different strikes. Like that's like 90% of what he does in here. Even his current question is kind of centered around selling 0 DTE spreads. You think Jpow would say anything if you cut him in line at Guitar Center? Probably. Yeah. You're not buying any more GME? Absolutely fucking not. Are you buying more top here? No, I got enough. Would you buy GME for $1? You gonna sell me your shares for $1? Sure. I was lining up potential zero DTE straddles, but worried one would get crushed on the data. Hmm. What are you doing with your GME shares? Sitting on them? I'll sell covered calls probably after today. That's usually what I do with them. I just sell covered calls. Drac, I need you to validate my 4450 Ps. I'm gonna buy. Okay. What about them? How become billionaire? Constant accumulation of wealth. Compounding gains, Dave. Have you seen Simplify ETF High? That is mostly T-bills, and then they collar TLT to produce a dividend. It's interesting. What kind of dividend? How constant accumulation of wealth? Rule number one, don't lose money. If Gork buys any more Jimmy, he'll have to post his form for her. No, I won't. 9.5% dividend? That's pretty good. Paid out monthly, quarterly? Or is the dividend just based on the prior performance of the collar? Fed data is released at 2 o'clock. Is it advantageous to buy a position just before? I don't know. Most people fuck up the like FOMC straddles. It's pretty easy to mess them up. I wouldn't buy Docu at this price, but a little lower, I might consider it. I still have mine. I sold $40 covered calls against it on their reduced guidance. I don't know. If it falls below 40, I'll probably just keep my shares that I already have. If it do I want to buy into it right now? Probably not. I don't really have any interest in going like long tech right now. At least not for the next couple of quarters. It gets a good price on it, but I don't like the macro. Please don't sell CCs. I don't need you driving my port any further down than it already is. My covered calls don't have that much of an effect on the price of GMA, if any. Is it bad that I think Farmville Player is one of my coworkers? A lot of things line up, and I mean a lot. Do you have a coworker that's battling a gambling addiction and a horde of wasps simultaneously? So assuming you had October 20 4250 Ps and October 20 4400 Ps for entertainment purposes, what calls would you use to protect them? I mean, I probably would have sold puts against them, not used calls to protect them, but you could also use calls to protect them, I guess. They're so far out of the money, I can't imagine they have a lot of delta left to lose. Have you thrown any batteries into the ocean recently? No. Don't we all have a gambling addiction while battling a horde of wasps? You know? Maybe. High second 30-day yield as of 8/31/2023 is 4.81%. Oh, okay. Yeah, so the dividend's variable based on the performance of the collar. That doesn't sound so hot, especially if we move into like a lower yield environment. Mm. Yeah, week's going alright. Thanks, baby. Well, I hope we get some juicy vol too. One time, wasps made a nest in my basement. I found out when I heard buzzing behind me and saw a swarm between me and the stairs. I was only wearing boxers, and there were hundreds swarming. What did you do? How did you get out of the situation without getting stung on your penis? Is there a chance we do absolutely nothing today after FOMC? I mean, there's a chance that the day ends flat back at 4450. How long until the stream features multiple angles that you cut back and forth between? Wait, is that a thing? Fuck. I don't have a timeline. That technology sounds out of my grasp. A large chunk of cash into Faz? I mean, that's probably a terrible idea. Just because you'd be putting a lot of money into a 3x leverage ETF. What do you think would support a flat close data wise? Uh, like a less hawkish shift in the dot plot and a pause. There's already some. There's already some sentiment in the bond market, like the based on pricing, that the Fed's not sufficiently raising rates to combat inflation. So obviously, the bond market's going to double down on that if the Fed doesn't project inflation appropriately to the current trend, right? So yeah, like an insufficient dot plot and a pause could probably lead to a fairly flat close. I mean, the end of the day is unpredictable. From 2 p.m. on, they're just going to be trying to close out straddles and strangles, and they probably won't finish closing them out today. So no hawkish dot plot. It depends on how hawkish it is. If it's if it's in the range that I projected it should be in, between 5.8 and 6.3, um, that's that's gonna force equities to reprice. Yeah, they may not reprice today, but over the next month they're gonna have to. Is GME gonna break out in the next 15 to 20 minutes? That'd be cool. What about a super dovish 2.5 hike? It'd still be a shock. Would you consider adding to the Tesla position before or after the meeting? I'm not adding to it. I already have it all. I probably, if I were to add to it, I probably wouldn't add to it unless it fell below like the mid PT. The minutes on the dot plot come out at 2. Then Jpow talks about them at 2:30. He said higher for longer about 1,000 times. People don't understand the higher part at all. No, equity markets are fighting the Fed because banks are losing depositors, and so they need to bolster their equity portfolio to account for that. It's always a wise idea to fight against the world's largest bank. I mean, the alternative is simply becoming illiquid, right? And not having sufficient capital reserves to satisfy depositor demand. If you lowered rates, the market would probably crash. It's a real economic indicator, yeah. I mean, they have data that supports their decision, too. Let them die. Get bailed out. I don't know shit about Canadian ETFs. It's all syrup based. Same like weed stocks. Hmm. The bulls don't have a lot of padding here. All right, so over the next hour and 15 minutes, I think if we see bulls push up, it's out of fear of a negative outcome. So the more they widen that gap between the spot and 4450, the more room they're giving themselves to de-risk in the event that Jpow is hawkish as fuck. I already think, I mean, based on yesterday, the de-risking at 4450, the de-risking that's been going on for the last week, um, on the sold put side, I would say that bulls already are significantly backing off of their like long-term bullish positioning, right? I mean, all you have to do is like look at like the long, like the like all expirations on SPX. It's pretty easy to see that most of the bullish positioning has collapsed, aside from the sold puts. You think 4500 POI for today is sold? Probably not. It could be. You could sell like the 4400 and the 4500 and buy the 4050, 4450. What would that look like? That's actually pretty decent. %14 return on risk. It's only 120 basis point spread after 30 days. That could be a reason. Shit like this could too. could do like that. Something like that. I guess if you drop this, if you go like there, or there, yeah, something like that. Protects the upside and credits like net short. So could be something like that. That's operating under the assumption that most positioning right now is probably fairly neutral. VIX is just massively shorted. Vol controls at like historic highs. Like 1 month correlation hit lows that it hasn't seen since like pre-Volmageddon. If I have SPY October 445 puts, is it better to roll out to November 440 now or after FOMC? I mean, why do you want to roll out the 445s? Isn't SPY trading at like 445? Do you just want more theta on them? Oh, you're in the money. Like is rolling them out better than just hedging them? Most of the calls at 4,500 right now are sold. It's disgusting, Bob. What about KVU Gen 26 $25 calls? I just got fill over the mid. But with the lack of liquidity for 2026s, I feel like I might have been a mistake and I won't be able to sell. What do? I mean, you could try to sell for the same price you bought at and choose a different expiration, I guess. Or, you know, just hope they go in the money and they start to get more liquidity as the price rises. More theta since it's approaching 30 DTE. I don't know if that's, I feel like repositioning is a better approach if you're already in the money. Grack, you're gonna make me buy more 2D poots. Why? What did I do? I haven't been overly bullish or bearish at all today. I have SPY 440 for 29. Don't want to hedge. Okay. Is it better to sell and wait out FOMC or roll out to October 20, 430p? Why don't you want to hedge? Hawkish, exactly. Isn't the Fed provision an additional total 50 BPS? No. They've only provisioned one more rate increase for 0.25. Or, well, I think 0.35 is the room they have, technically. Where do you see full bear going today? Test of yesterday's lows. Seems unlikely they'll let it go much with added Vega risk from yesterday. I mean, how bearish are we talking? The Vega risk means that the downside could become exposed even faster, right? So the fact that they sold 35 and 15 yesterday, if we were to get a sharp move down, means that risk would just compound faster and the drop could be much quicker than yesterday's. If Jpow finds his nuts today and raises rates, do we fall bigly after they rescue calls and sold puts? Yeah, over time, probably. Jpow is going to say that his mission is accomplished. So he's just giving up. I think that might be the most bearish outcome. What would you suggest hedging with? One DT at the money calls? I've not had good luck with straddles. Why? Seriously, the question there is why? What about straddles has been hard? Just timing the tops or setting stops or cutting the dead leg? I mean, you could, if you bought like a short dated call and the market moves up, right, against your longer dated put position, then it just pays for your puts, right? The call does. Um, if the market breaks down, then you just cut the call. Exiting the dead leg is difficult, even when hedging it into a spread. I think that's just like a nervousness. People just assume price isn't gonna like mean revert, and they get scared of holding the dead leg. I wouldn't sell puts into today at all. I don't think selling a calendar spread is the right way to hedge your short put. How many more 0 GTE 4480 Cs do I need to buy? You know the chances of those going in the money is very, very small, right? New here, thumbnail clickbaited me. Had to do a double take and laughed pretty hard when I saw it. Appreciate it. Welcome. I just got out of 4 meetings, making coffee. How's the day going so far? Boring, as expected. Do you just walk your stop up loosely as price action goes directional? Yeah. It's not No, it's not binary event. 50-50 chance it's either in the money or out of the money. Oh, Jesus fucking Christ, popcorn trader. What if the market only goes up to the like larger pile of call gamma at 44.75? The 44.80 never goes in the money. People start selling it and the spread widens and the IV crushes out, and then you're stuck with a big pile of bags, $5 out of the money, and then the price plummets. Are you gonna explain baratory to the new guy? It's too soon, Dave. It's too soon. It was profitable between 437, 446. Do you think I should just dump the 438p 929 before 2? I feel like dumping it yesterday would have been better. Can't you sell like a put against it? See, everyone keeps asking me about like bullish and bearish decisions. I wouldn't approach anything today. What? Why not just turn it into like a condor or something, so that you're neutrally positioned against the 29, right? Like you could just uh what expiration are they? The 29th, and you have a 38? Can't you just do something like that at net credit? Or I mean, you could even like tighten that up a little bit, right? That's still a net credit. It's not great, but if it falls, like if it rises, you still get your net credit, right? So if it goes over 46, you'll make 12%, which is dog shit, but you won't lose money. And then if it falls, you make profit. You get like 120% of your max risk, which is probably better than having a dead put. Also, you could do these all like one DTE, right? Yeah, that sucks. Don't No, that's garbage. Two? Two might be better. Mm. Hmm. That doesn't seem terrible. The only thing I'd worry about with doing the shorter dated is that like you're gonna end up running into like some pin risk. And then you may have to take a loss to close a leg. But I don't know. So something like that seems better than just losing money on the put. Hey, Girk, I just got back from Alaska. Any reason they haven't shorted Fubo and are keeping it elevated at these levels? Actually, Russell's been pretty resilient the last few days. It's having a good day today. Do you think a straddle 44.55 right before the meeting is the best play and can profit on both ends during the volatility? No, I think a straddle earlier at 44.50 was the best play, and that window's gone. And I'm not saying that that's the best. I don't know what your cost basis on your put is, so that may not be the best setup, but something along those lines, right? That way you can get some like bull exposure and maintain the bear exposure. Okay. While having a neutral, like an overall fairly neutral position. I think it should also minimize your max loss. You can ignore my question about the 4480s because I bought 4490s. Oh, Jesus. When you want to change all the 1 DTE to DTE, you can click the 20 on the horizontal expiries, then click the 21 next to it to change all positions from the 20th to the 21st. Oh, shit. But I don't want to change all of them. I just wanted to change 3 of them. We're reaching that point of the day. If you may do my port the pleasure of taunting an out of the money 0 DTE call to 8x in 10 minutes again, I'd be mighty grateful. Oh, and a put for the pullback. Just, I don't know what kind of fucking stock magician you think I am. Hey, Greek, I've been here a while since I've been around. Oh, been a while. So just stopped in to see your thoughts on dinner. Perhaps a hot dog taco. Hot dogs are tacos. I'm confused. So 44.55 is not the best, but not bad. Yeah, I mean it's not terrible. I know he won't, but what would happen if Jpow raised to 7.5? It's not gonna happen. The Fed fund futures would have to reprice 0.75. Tips would have to reprice. Yields would move up super fucking fast. Dollar value is gonna rocket. Uh, the bond markets are gonna reprice the projected curve of inflation over the next like 12 months, and they're gonna have to reprice the federal funds rate as well. Row would skyrocket. So long dated call positioning and sold call positioning could generate risk. It's not going to happen. So I don't know why we're going there. A lot of things. A lot of things that would have to happen very quickly. It's called the cube rule of food, Junkman. Feel free to annoy anybody with it that you want. But hey, the carry trade is saved for a few minutes. No. Yes and no. So the carry trade spread opens up on the rate increase, right? But dollar value will simultaneously skyrocket, which will pressure USD JPY and probably push it up above like the Japanese Ministry of Finance 150 target, which means that like the Ministry of Finance in Japan is almost immediately going to start like open market operations that are short dollar, long yen. And then their rate decision is in like a day, and it would probably push them to drive their monetary policy positive. So I don't not for long. Maybe not even a few minutes. I did. I used it. I said the thing. We need to get Greg to become Fed chairman. Then he can tell us what the rate is going to be accurately. Well, I did tell what I've been extremely accurate on the Fed's rate increases. It's not hard. You just assume they're going to do what they say they're going to do, and then they do it, and then everyone's like, "Oh my god, I can't believe they did the exact thing they said they were going to do." I can't wait for 3 months from now for like bulls to be shocked. Like the Fed has maintained a higher for longer data driven dependent policy for the last 3 months. No one could have seen this coming. If I was Fed chair, the interest rate would be 20%. All the banks would be dead and you wouldn't have a job. So that's you probably wouldn't like that. He said he was going to fight inflation. He has not. Have they really done what they've said? Yeah, but he was going to fight inflation with like a really soft dick, you know? Just push and rope against inflation. And he did say he was going to do that. He was honest. You think the Tesla short play is invalidated by all this pump? It could be. It's up to you. Ooh, gross. Well, I don't like that. Did I get stopped out? Apparently it is. I guess I gotta wait for 75 again. Fucking Christ. Oh, that wasn't a very good stop either. Yeah, well, it was alright. Hold Tesla calls till minutes drop, or set a stop at this resistance, hypothetically, of course. I feel, well, I mean, once 271's generally been more of a support than it has been an upside resistance, but you could, given that it's starting to reject, like a slightly out of the money stop might not be bad. Frauderizing the economy. Oh god. Are we going there now, Dave? Fraudage, really? If I were Fed chair, I would probably have an aneurysm. Soft dick inflation sword. I've been corrected. Thanks, Gorg. No problem, man. Was there news? Some sort of Tesla-based news? No. Cool. Australian financing partner. Oh, alright. What time of the day are the Japan announcements? Oh, for their interest rate decision? I believe it's tomorrow at 11 p.m. EDT. What would happen to VIX if the Fed hikes? Well, yields would bump, right? And so bond portfolio holders would have to hedge VIX convexity. So more people going long VIX. I mean, that doesn't necessarily mean VIX will go up, but it'll put some pressure on the oversupply. Rate decision at 2. Yep, data's at 2. Speech is at 2:30. Don't normally trade Tesla. Looks like 275's on the cards. Probably. I don't know what the financing deal is. I don't see the news on it anywhere. I got fucking stopped. So Tesla partners with CBA to streamline financing. Commonwealth Bank of Australia. Customers can apply to CBA's financing loans directly to Tesla's website, enhancing user experience and broadening their financial choices. Tesla customers can apply for their CBA secured personal loan with a fixed rate of 5.49%. I don't know what Australia's current rate is. But it sounds beneficial for Australian customers. Maybe? What is Australia's rate? Australia's fucking central bank rate is only 4.1. It's not even a good deal. Ah. Fuck that. Bullshit hype. But yeah, 275 could be on the cards. That's the next upside resistance. How are GME tips looking? Still like shit. Also, XRT went on Reg Show last night, which usually means OPEX is dead. Do I have time to get something to eat before the data? I think I do. I hope TUP doesn't run. Well, I mean, I hope it runs, but I hope it doesn't run while I'm getting food. Give me 1 second. I'll be back in like 10 minutes or so. Perfect. Nothing fucking happened. Betting on ups while he talks, then downs. I'm gonna bet on ups before he talks, then downs while he talks, then ups at the end of the day. Will you pay me if I'm your food errand boy? Like a personal DoorDash? Hmm. No. Don't you have a job? But then I can unionize under you and strike. To what end? Like, the labor you're replacing is already readily available. It's probably smart to give more theta to the side that you think wins. I bet that my port will be down before he talks, during, and at the end of the day. Can you do an inverse? Wait. Can you do a straddle using 2 iron? Hold on, I'm reading another comment. I just lost the comment I was trying to read. Where did it go? Semi-strangle using 2 debit spreads. Yes. That's an inverse iron condor. Although I would say on a day like today, an inverse butterfly would probably be better. If you're going for 0 DTE. Oop, here's the crash. Oh no. I'm seeing a lot of bearish bias. Is it because of the CPI print? is because Jpow doing a pause here is stupid. Also, the market's been bearishly biased since CPI, right? So, both. But yeah, long positioning has been de-risking for like the last week. Now that we think about it, inflation could be bad. I mean, equities are still priced with the assumption that rates are going to be cut before the end of this year and then aggressively cut in the first half of 2024. They're completely in disagreement with the bond markets, who clearly think rates should go higher. Well, my stop got skipped over on Tesla. Hopefully Jpow's a hawk today. I mean, if you have some theta, I wouldn't worry about it too much. I don't think them getting slightly worse than median financing from an Australian bank is a big deal. It's not a pause, it's a skip. Hawkish skip. If only the Fed would say whether they will go higher for longer or not. What if they had like a meeting every year somewhere rural, you know, where they could really focus on their work? I don't know, like Wyoming. And then the conclusion of that meeting was that the current federal funds rate was moderately restrictive and possibly sufficient unless data showed a change in inflation moving forward. It's a hawkish wait and see. He's trying to wrest back control of uncertainty. Does this mean I've won free membership 3 times now? Thanks for all you do, Pi-Fi. Apparently, Larry. Congratulations, and you're welcome. I didn't name my cat Hawkish Paws. What PETA member named all of the stock market slang after animals? Animals are cool, man. The pickle jar is the Fed now. We should be. Even fucking Popcorn Trader could have solved inflation at this point. Was that just a little premature dippy on SPX? That's what happens when you're at neutral and someone buys some slightly more puts. Dork's not here. Everyone say Bip. Excellent job defending Dork's honor, Fluffy. I'll let him know. Is that indicative of what's to come? Not at all. Meanwhile, 10-year, 3-month, still not above -1. So Dork is gone. And he predicted elevator shaft pattern. I think he bet on himself. Okay. He might have. He does have a put. What range do you think SPX will trade in during the meeting? Potentially between 44.35 and 44.75. That would have the highest confidence. Just did, Freddie. Maybe it's more like 75-25 now. Ooh, interesting. Did they just JFresh? Did they just close their short puts at 44.35? Hmm. What's a short put? Are you trying to say shot put? No. It's a put that you sell, Popcorn Trader. It's the put most same like call. You can't sell options unless you're a market maker. You're you're officially certified. I'll send you a certificate later. Welcome back, JFresh. Don't worry, I got a guy. If you could translate that to Somali, I would appreciate it. Hmm. Has Juice Caboose refilled her coin purse yet? It's a little heavier than it was. Nice, actual Dan. Cut the shit. How's the cat lady's friend doing? My honor defending stops at 1, so bips away. And they say chivalry is dead. I think ups before Jpow, down when he speaks, and then ups rest of the day. We're already going up right now. Data comes out in 7 minutes. It's just going to be volatile. All predictions on price into the end of day are worthless. We don't know what the Fed's going to say. We don't know how they're going to say it. And we don't know how much of the neutral positioning is going to be pulled back effectively before the market picks a direction. So unless you're positioning neutrally, stay the fuck away from it. Right? It's not that hard. I defend you, Greg. I can subsist off squeezy cheese alone for weeks. I believe you could. You savage? What did I do? Can you label the top on your chart for us? Do you scalp the volatile swings after the rate is published? No, I usually don't. I use them to. I mean, I guess I do. I use them to close my neutral positions, but I don't enter positions specifically with the intent to scalp directional moves after the rate's out. That's just a really good way to lose money. Like watch an option go up 400% and then all the liquidity disappear instantaneously as it drops 30 BPS or jumps 50. I mean, it's just, yeah, it's not ideal. Oh. I got my federal deck stamp yesterday. How many letters can I write with this $25 stamp? Infinite? When it picks a direction, can you let us all know so we can sell the other leg? Oh, Jesus. Really? You don't want to talk about Cat Lady's friend. You know what you did. I feel directly impacted. We're keeping things quiet. One ounce forever stamp is 66 cents. Depends on other factors, but I'm here for the squeezy cheese. No problem, Tim. We talked about incentive last week. Bulls are incentivized to push the put wall at 44.75-ish. Bears then incentivized to push down toward 44.35, 44.25 now. They pull. It looks like on that drop from 55, it looks like they pulled back a lot of the short put interest at 44.35, so they de-risked a little bit of the downside. As far as incentive goes, I mean they're both incentivized to bail out their positions before any directional move is actually taken, right? So probably just a lot of volatility. It's pretty rare that a Fed decision leads to direct and continued price action. Usually it just creates a ton of chop. Wide chop. Big, wide, volatile chop, but chop. When did we test 44.60? You never would have had a put. I got here at like 10:30. I wasn't here for that. How could you have challenged me if I wasn't here? So you bought a 44.60 here and then perfectly timed the top on it? Yep. That was interesting. The fucking data's not even out yet. The fuck was that? It was like a minute too early on their big Vic short. All right, let's see what we got. Statement. Maintain target range. So pause. Dot plot. Fuck. Median unemployment for December, 4.6%. Rough. Projecting inflation still goes down. And a Fed funds rate of 5.1. Oh, interesting. Wait, hold on. Change GDP, unemployment up. PCE inflation, they assume is going to continue down. Core, they assume is going to continue down. Cut? Are they saying they're going to drop rates? Hold up. I mean, yeah, look at the fucking dot plot. For 2023, they're projecting 5.1, which is under the current rate of 5.25. Well, the participants are in agreement on another 0.25 by the end of the year. So that's telling us the bank situation is much worse than we think. That's pretty bearish. Also stupid, but distribution of unemployment projections. So they're saying we hit 4.5, 4.6 unemployment. Do they have unemployment data that isn't out yet? So they're projecting a recession. Their uncertainty about inflation, employment, and GDP are all weighted higher. Yeah, all higher. Hmm. Settle at a 2.5% federal funds rate in the longer run. 4% by the end of next year. Well, that's higher. So they've raised the 2024 federal funds rate target, but they've lowered the 2023 federal funds rate target. Take operations at the same rate. Minimum bid rate of 5.5. Conduct overnight repo at 5.3. Federal reserves exceeding a cap of 60 billion a month. Voted unanimously approved and established a primary rate with the existing credit level of 5.5. 5.360. Okay. No change. Interesting. I wonder how he's gonna spin this. I guess we'll see. Because, I mean, they're very clearly projecting a recession. Which is the only excuse for a rate cut now. Soft recession? There's no such thing. Don't full port anything. Just wait for him to talk. His guidance is going to matter a lot here. How would you describe the landing these days? I think the landing gear fell off the plane somewhere around SPX 4600. We had the mid-March one open. Yeah. Did I open the wrong one? Oh, I did open the wrong one. Never mind. Bro, I know. Still projecting a recession, though. Change in GDP. That was confusing. All right, so GDP flat for the next 4 years. Unemployment rate up into 2025. PCE inflation slow climb down, although they do project it'll move down into the end of this year. Core PCE, a slower rate of decline, but leveling out into 25, 26. Fed projections, still one more rate increase this year. Although members are slightly more split, and they're completely undecided on rate increases for 2024, with only 5 members falling below the 5% terminal rate. 6, 7, 8 members. So 8 members above 5%, 8 members below. So completely undecided on 2024's rate. That's probably pretty bad for equities. And then the majority of projections are for 2025, a rate below 4. So that should kill the equities assumption that there are going to be aggressive rate cuts into the end of this year and next year. No cut next year, really, either. Even if there is a cut next year, not nearly as aggressive as equities are projecting. Sorry about grabbing the wrong one there first. I hope I didn't give anybody a heart attack. Seems like uncertainty was pretty high around GDP and PCE projections. Really no change, no projected change in the federal funds rate going into 2024. Very little in their median projection. And their confidence interval could see rates climb as high as 6.75, it looks like. And that's here. So here's the projection. So this is their median expectation, right? And that would be rates at 5% by the end of mid 2024, end of 2024. With a possibility of rates going as high as it looks like 6 to 6.75. Yeah, the Epic Pen's offset. I just realized that. Yeah, I can't do it blind. Fuck it. So that's not particularly bullish. With the data, there seems to be not a lot Jpow can say that would be bullish. Just data-driven and tools. I mean, we only need 1.1% unemployment to officially hit a recession, right? Well, actually, hold on. So the low in the prior 12 months was 3.4. So our base effect. 3.4, and we're at 3.8. So from September, so the low's 3.4 to 3.8. So we need point four change. Sorry, yeah, 0.4 change in unemployment is officially a recession. And then the Fed's projecting unemployment at 4.5 is the June projection for 2024. And then June, April, Feb, May, June. So June's 3.5. Yeah. So they're projecting a recession. They're projecting it, I think, too far out in the future, but I also don't think they're adequately accounting for the current spike in energy costs. But it looks like they won't probably until Jan. $44.50 0 DTE calls here smart. They could be, yeah. I'd imagine if there's gonna be a bullish push to the upside, it will either occur before or during the initial part of his speech. Although it just may not. That's always a possibility. Did you already close some puts? A few. About 20%. Yeah, I guess it's like 24%. Basically, at this point, Jpow has the data and the report to give remarks that they've achieved a soft landing while projecting a recession in 2024. That's going to be hard to pull off. That'd be ballsy as hell. Super core is up. So's core and PPI. PPI is going to be way up next quarter or next month. Gives him time to step down. I mean, yeah. Jpow dropping breadcrumbs so he can later say, "Ah, crud muffins. We goofed on our doofy math." And their fucking estimates for 2024 are a joke, though. Like all of their projections are highly uncertain. Except, I guess, GDPs, but it's weighted to the downside. Uncertainty about the unemployment rate is really high, weighted to the upside. PCE inflation is very high, very uncertain, and weighted to the upside. There is no money printer. We printed the money. Are we bullish on top? No, not at all. Are you? Do you know anyone who owns Tupperware? I made you something in your DMs. Okay, that's actually fucking awesome. All right, guys. So we've had our quants do the fact checking on they've just finalized their report. These are the current Fed projections. Step 3 profit. What mean for mortgage rates? Higher for longer. Sounds like house prices might have to come down. Credit event in 2024. Nice. Oh, we both know it probably won't take that long. 2024 inflation 22%. Bond yields go burr. Have they started? They're burring a little bit in the 2 and 5 year range. 10, 20, and 30 are still negative on the die. I hope someone asks about Latino representation. Yeah, that's been ignored for far too long. Thank you, by the way, Chris. Nothing he can say to bring these up. I don't know where you have calls, but if you're at like 44.50, he doesn't need to probably say a lot to get those to go back in the money. Crash deferred for another few months. I mean, not necessarily. USD JPY just is about to hit 148 right now. Pauses aren't bullish. If the real rate is considered restrictive right now, or sufficiently restrictive, which is kind of what the Fed is saying in this report, they're saying that we've basically done enough, but we're gonna do one more. Then yields are gonna start to expand, right? Credit spreads are gonna contract, and dollar is gonna go up. And bond yield to S&P earnings yield spread is going to invert. That's not an opinion. That's just the effect of holding a 5% rate for another at least 6 months. Possibly year and a quarter. After the report, do you think we see Downies the rest of the week after Jpow puts the nail in the coffin? Let's see what he says. I don't think anything. We here at Pickle Financial are going to be data dependent moving forward. Does this mean bonds are more attractive than equities? They're gonna probably quickly become more attractive than equities.
currently they're a little less attractive than equities because of the rate of inflation. But over the longer run, they are already more attractive than equities. That we should see that be incentivized more with the projection of holding the rate higher for longer. Also, equities are pricing in currently at our current prices are pricing in the assumption that there were going to be aggressive rate cuts beginning at the end of this year into early next year. That's now gone. So I can't imagine the reaction over time is going to be very bullish. But remember that economic data is not as important as current positioning, right? So right now, we've got some puts that are sort of not really, but a little bit taking profit on the downside move here. I'm actually surprised at how little profit they're taking. And then there are call side straddles and strangles to the upside that they're going to want to bail out. I demand you pontificate on the unknown in a way that reinforces my biases and soothes my anxieties. I would prefer to raise those anxieties. Anxious is good. You're less likely to YOLO your money into shit. Bullish for my SQQQ calls. Mine too, yeah. I really like that tech is down 20 BPS today. Nice and slow. That's the best way to get SQQQ calls to print. Just a slow trickle down over weeks. No, I don't have SQQQ 40s. I have 20s, but I have a lot of them. I can't wait to see Tom Lee on CNBC tonight talking about how the feds will likely cut rates hard before the end of the year, even though they just said they're definitely going to raise them at their last meeting. All right, let me pull up the. Suck. Nope. Boop. Shrink that. How do you know when cow tongue is cooked enough to eat? It should be really tender. All these large funds and banks are independently hedging the Fed. Why do we typically just get one concerted move up slash down then reverse? Shouldn't it be more staggered? I mean, it kind of is. This is This is looking far more, well, bearish right now than it usually does. Ah!
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points.
Do you have a fucking
and have
iPod?
continued to reduce our securities holdings
Bro.
at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of
pumping
additional
Apple?
policy firming that may be appropriate.
Yeah.
Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing
This is the
economic
March?
developments.
What the fuck do you mean? This is the March stream.
Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job
I've got it
vacancies
as
have
loud as it
declined
gets.
so
He's
far
really
this year.
quiet today.
Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In
He
addition,
didn't say sufficiently restrictive.
the economy is facing headwinds from tighter credit conditions for households and businesses. range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median
Fuck you,
projection
bulls.
is unrevised for the end of this year, but has moved up by a 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan.
What
If
mean?
the economy does not evolve as projected, the path of
Basically
policy
no
will
rate
adjust
cuts.
as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary
I love
policy.
how today is the day where they
the
actually
lags with
hire a
which
fucking
monetary
sound guy.
policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to
Why does this keep lagging out?
keeping longer-term inflation expectations well anchored.
The fuck?
It's essential to set the stage for achieving maximum employment and stable prices over the longer run.
He's streaming on
conclude,
Apple, of course
We
it's
understand
shit.
that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that.
Commercial
But
debt
the fact
holders
that we
are
decided
fucked.
to maintain
Yeah.
the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're
Ooh,
seeking.
uncertainty.
If you looked at the SEP, as you obviously
Fear.
have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year.
Dork
Others,
did the sound for
believe
this
that we have
meeting.
already
That's why
reached
it's
that.
so
It's
crisp.
something where we're not making a decision by deciding to, about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, yeah, no, clearly we are just, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and you know, we're seeing progress, and we welcome that. But, you know, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50
Oh, your
basis
call's
points higher?
fucked?
Right, so I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a
don't
good
say
thing. We need
meaningfully.
a policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, you know, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, you know, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
God, he's like Neo in the
Hi,
Matrix.
Chair
just-
Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, you know what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, you know, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, you know, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, you know, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you know, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. You know, we've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to
It's an indicator
one
of
hike,
bank positioning,
in macroeconomic terms. Nonetheless, you know, we need to get to a place where we're confident that we have a stance that will bring inflation
But yes,
down to 2%
it shouldn't be
over time.
considered a predictor.
That's
of
what we need to
anything.
get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Thanks. Let's go to Steve. Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell you that, does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't you know, the model and that the economy reacts. And again, that's another reason why we're moving carefully now, because, you know, there are lags here. So it may of course be that the neutral rate has risen. You do see people, you don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that you know, that the neutral rate at this moment is higher than that, and that that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a
Does this seem the same data as us? Core's
to get
trending up.
inflation
I wouldn't call
consistently
that
back to
good.
2%.
Seems like they're
You kind of
ignoring the
get that in
recent spike in
2024 a little bit,
inflation
1.5%
due to the
is
lack
just a
of
touch
3
below,
data
What's
points.
the estimate of potential?
Although they'll have to
So,
address it at the
the
next
fact that you're
meeting.
getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's
The debt
necessary to
reservicing
achieve
is going to
this?
be obscene.
Yes, of course, it is a good thing. that
Above
we've seen
5.1%
now
at least.
meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right, in the median forecast, we don't see a big increase in unemployment. We do see an increase.
Losing 50
but
again here
that
was
really
pretty,
is just playing forward the
pretty
trends that we've
bearish.
been
This,
seeing.
I mean, nothing being
That is
said
not
right now
guaranteed.
is
There
bullish.
may come a time when
Nothing
unemployment
supports
goes
the
up more than
long-term
that,
bull
but that's
thesis.
really what we've been
Nothing
seeing.
supports
There's
the
progress
medium
without higher
or short-term
unemployment
bull
for now.
thesis.
So just to boil that down for a second, you know, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that?
Fuck!
I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's
My
also
man.
possible that
You
the path
just
is
found your
narrowed and
balls?
It's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think
Fuck
I do
yes.
think it's possible, and you know, I also think, you know, this is why we're in a position to move carefully again, that we will restore price stability. We know that we have to do that, and we know the public
Yeah, you
depends on
will.
us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, you know, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say, you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, you know. And so what are we seeing? We're seeing, you know, through a combination of the, you know, the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, you know, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects
Energy.
of it in
It's
non-housing
in energy.
services as well. So
Say
I
energy,
think we think
fuck.
that is working.
Say it.
And I think what, you know, as we've said, we want to reach that, we want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, you know, enough data that you feel like, yes, okay, this feels like we can for now
Not so much yet.
decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but
Jesus
we
fucking
would,
Christ.
let's say if we get to that
Politicians.
level. And then the question is how
What
long do you stay
energy?
at that level? And that's a
Energy
whole other set of
demand?
questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point.
Why is the stream so bad today?
Of confidence about that yet. That's the stage.
This year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting and
Productivity is
certainly
a
at the last
problem
two
too,
meetings this
yeah.
year, it's going to depend on the totality of all the data. So
Higher quality
inflation
audio
data,
is
the
requiring
labor
more
market data,
bandwidth.
the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether
Somebody
we
better
should move
ask them
forward
about
with another
fucking
rate hike
energy. I'm gonna be
overall,
pissed off
and
all
whether
day.
that would increase our confidence that yes, this is an appropriate move and it will help us be more confident that we've gotten to the level that we need to get to.
Gina. Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. You know, is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, you know, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, you know, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting. I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain. And that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation?
Yes.
That's going to be the question. It's not a question about GDP on its own. It's, you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Narrator, it was a threat.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see
yes.
Auto workers striking. There's the
Say the bad
very
things,
real
all of them.
possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's the government shutdown, resumption of student loan payments.
Say energy.
Higher long-term rates, oil price shock. There are a lot of things that you can look at.
Yeah, oil price shock.
And so what we try to do is assess all of them and handicap all of them. And ultimately,
shock
though,
again.
There's so much uncertainty around
Shock,
these things.
awe,
To start with
uncertainty,
the strike,
fear.
first of all, we absolutely don't comment on the
Kill the
strike,
wealth
as
effect.
We have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So. The thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So
We are
you just have to
lazier
leave
and
that
fatter than
uncertainty
we've ever been historically. Don't lie to the people about productivity. And fix your fucking stream.
We'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect, over time, a sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum. And that's what we start with, but we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is
were
seeing
you?
added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up where people can add
Wrong.
skills. Workers want to work.
Wrong. They're
We
on
have a boom in
TikTok. They're not adding
manufacturing,
anything.
Construction. We've had a decent spate of home
No
building.
offense.
And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good
Nope.
for the Fed's longer run target of low inflation. And if
Liar.
we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
Lost decade. Thank
To
you for your
begin.
question.
A soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where
Is this
the
guy
economy is
really
just
the
very
bear?
uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of
Brother
these,
Rob, I'll address that
distortions
after
to
this
both
is
supply
over.
and demand.
But there's
that
more
happened because of
there's
the
more
pandemic and the
nuance to that.
response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Go to Mike.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.
Disinflation is a lower positive rate. Deflation is
What
a
would
negative
justify
rate.
that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates.
Awkward.
Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. You know, we were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at, you know, really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets.
What the fuck reports
Headline
is he
inflation, of course,
looking
has
at?
come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But
iPad's upside down.
These are
apparently.
our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast
It's not that
that you
hard.
have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast
Fuck
in
was that?
the rate increases that we've made.
Aliens?
And I think it was important at the beginning that we moved quickly, and we did.
I said
and
inflation
I think
was
as
gonna
we
go
get
back up
closer
in
to
fucking March.
The rate that we think, the stance of monetary policy that we think is appropriate to
It's back up.
bring inflation
Forecasting's
down to 2%
easy.
over time, you know, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening, it becomes more equal. And I think the natural common sense thing to do is, as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
I didn't get my doctorate at 13.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was what factors?
The base factors.
Base factors.
The base effect.
Okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation?
Raise of hands. Who's still holding the call side?
Would you feel more comfortable?
I think I'm stopped out. Yeah.
Yes. I mean, if you're looking, we can tell how
Although
much
I wish I'd
inflation has
held
gone
more
up in a
puts
given month,
longer.
right? And that's what we're looking at. And month by month, what's the reading?
Yeah, that's fine.
And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last 2 inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really.
But they have
going.
a lagging effect
However,
on core.
we're well aware though that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
Oh, yeah, on the consumer, they're putting more and more of this on their credit card. The consumer seeing, record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we
interrupted
Jpow.
Jpow. That was your last FOMC.
Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows.
Enjoy covering
quite
the
recently,
Secretary of Education
during
from
and
now
after
on.
the pandemic. They're now moving back up to normal. We're watching that carefully.
He won't
But
be there when
at
the
this
camera
point,
pans
these
back.
readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about
61
taking interest
popcorn
rates
trader.
to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may
DN's
be
at
below or at the
4403.
same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move move now, they would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that's spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed-rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to
Jpow, working
continue,
for the
which is
poor
that
by
we're
destroying
making
as little
progress
wealth as possible.
without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume.
Take
and so
away
they're
their
not gonna-
avocado toast.
It's not going to affect them as much.
Flag.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the beige
Few
book
million,
recently,
good time.
you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans.
Not my
moderate
toast.
income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs. And now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Just fucking bounced. Irish goodbye. That's a I almost need to rewatch it to see how many times he contradicted himself, but there was a few. Or intentionally misled on the currently available data, because there was a few of those too. I don't think anyone bought into it based on the price action of the last couple hours. Obviously, we've drifted down here. The earlier de-risk of 44.35 that we saw before the meeting has kept volatility from moving up too much. But should we slide further below 44.25, that could begin to walk up even more. I think if there's an attempt to rescue the 44.50 strikes, or what's left of them, we'll probably see that sometime here into the end of the day. maybe on the back of some 0 DTE put capitulation. I feel like he was pretty clear that the soft landing is, I mean, the soft landing has always been like a goal, but not, you know, a guarantee, right? And I think in his initial statement, he was trying to reinforce that, you know, it's not like the Fed's guaranteeing a soft landing. It's something that they hope to achieve. And I think he got a little tripped up, and he got tricked by the next question a bit. But yeah, I mean, nothing coming out of this is bullish. So what we're looking at ultimately is we're looking at a federal funds rate moving up to 5.6% by the end of this year. And that means another 2.5 hike, basically. You know, so a range of 5.5 to 5.75 is how it will be presented. But you know, with the effective rate at 5.6. And then this is where the bull case kind of falls apart. Previous to this dot plot, there was a projection that, you know, the Fed rate would then go down. Starting from the beginning of 2024 into 2025, there was an expectation to cut rates aggressively. This case was the final supporting piece of evidence for any bull case and continued earnings yield into 2024. This is gone. The Fed now expects to cut rates, but nominally in 2024. And really no clarification on what part of 2024, but probably, you know, into mid 2024, their June projection. But they plan to maintain a rate above 5% or 5.1%. And into 2025, which means no 4% rates next year, no 3.6% rates by the end of next year. All of this needs to be repriced in Fed fund futures. This needs to be repriced in the bond market. And more importantly than anything, this needs to be repriced in the equity market. That effect over time is not conducive to short or midterm growth. Now, the Fed is largely trying to ignore the effect of energy. They're not, I mean, he was very obviously trying not to address it, even going so far as to ignore the already visible knock-on effects on core inflation. But I will say this, separate from, you know, his statements, energy's effect cannot be removed from core. So higher energy prices for a sustained period of time will be realized on the producer side, which they already are at a very, very rapid rate. And they will be bled over into core services and goods, and durables, especially. And that lagging effect of energy into durables, I think it's already being realized. We've had higher energy prices pretty consistently for almost 3 months now. Next print is going to be even higher. And so the Fed is avoiding, you know, they've got 2 hot prints. They're avoiding discussing that effect because they don't have 3, primarily. I mean, they don't have, generally, they haven't in the past spoken on data points that don't occur in triplicate. And that's, that's kind of the 3-month quarterly trend that they're looking for, because obviously, the hope would be that energy prices fall and then we get one more hot print and then they start to cool, which is clearly what the Fed projection is assuming currently. I don't think that's true. I think the strategic oil reserves are down. U.S. ability to control oil market pricing is not very strong right now. I think Saudi Arabia and Russia and possibly other large oil producers will hop on board in extending these production cuts. Because the U.S. has so little influence over the price of oil, they can really get the median price per barrel where they want it, and for what's best for their economies that are driven, where their growth is driven by the price of oil primarily. So a little bit of advantage to them. Also, any shift in China's current economic outlook, any planned government stimulus by China would be bad for China in the sense that they will compound their already egregious debt. But at the same time, they need to do something to stimulate their economy. Otherwise, it's kind of in a free fall scenario. So the expectation should be that China will take steps to protect their economy and to try to stimulate it in some way or another. And if they do, that is going to create a even stronger demand on what is already a fairly weak oil supply. And I could see, at that point, like right now, I think oil can roughly sit where it is, between where it is and 100 a barrel. If that Chinese demand comes in, we're talking oil to 110, maybe 120 a barrel. And then, obviously the inflation effect, the bleed over effect into core, not only is all of that going to last a lot longer, but it could be significantly greater. Someone asked earlier, why not raise 100 BPS right now? And that also has to do with inflation also, and it has to do with the destruction of money supply broadly. That the Fed needs to continue doing effectively. And if the demand for bonds, long-term bonds especially, is low, and the Treasury is issuing securities at a steady pace, then the Treasury's issuance becomes additive to broad money supply, right? And then raising rates inherently will make the Treasury have to pay more to service that debt, driving more inflation. So Jpow needs to keep rates fairly contained while decreasing economic projections in order to increase demand on those longer term yields, right? And the best way to do that is really nominal rate increases and pauses, right? Like keep applying the pressure, but keep the rate steady and push that, extend that window of time that will exist out further, right? Which they've done at this meeting. They've extended a strong federal funds rate into the end of 2024, right? And by creating that demand on the long-term yields, Treasury issuances no longer have that additive effect to inflation and money supply because he hasn't really jacked up the rate. He's just increasing the demand, right? So he needs to get people to eat the shit sandwich and take the treasuries at face value and stop trying to get, milk them for more. Like a lot of banks don't want to go long on the yields because they want yields at, 7, 8, 10%. And he's not going to let them have that because that will drive more money. Like reaching that target for the banks will drive, the bank's risk back into the treasury, and the treasury will have to expand money supply. So he wants the banks to take the losses, not the treasury, not the Fed. And it is correct, right? And a large part of the reason that interest rate increases don't really do anything besides that is because our current inflation environment is not driven by over lending practices. Our current inflation is driven by supply demand, and then excess demand and wage inflation due to excess demand and supply side inflation and profit inflation, right? So we'll see. We'll see if it works. If the banks are gonna fold, they should. They should, because he's just told them they have no rate decreases in sight, no chance to buy the top on the yields anytime soon, and debt servicing is going to come in hard into the beginning of first half of 2024, and that debt looks like it's going to be serviced at a rate of 5% or higher. And as far as future growth goes, that's bad. That's that's a big headwind. What debt needs servicing? It's about 30% of the S&P 500s, or there's 40 something percent of the S&P 500's rotating credit supply needs to be serviced within the next 2 years. Or wait, are you guys talking about the Treasury, or rolled over, or are you talking about the Treasury debt servicing? The Treasury has to service the national debt. So when they issue securities, they have to pay the interest on those securities. If Jpow raises rates, the price of the yield on those securities goes up, which costs the Treasury more money. If you're talking about the restructuring of corporate debt, yeah, it's like 40 something percent over the next 2 years. It's far more than that broadly, but I only know the statistic for the S&P, and even that's loose. I'm not really sure on the exact percentage. It's somewhere between like 38 and 43. What I don't understand is how market forces won't take effect and fix the issues over time. We can't trust them to do that. I agree that we should have a crash and we should force a recession, and that's the fastest way to the goal that the Fed is trying to achieve. It's just the most painful one. Just let everyone my age in the office know that Fed funds rate won't moderate until 2027, meaning in California, housing prices will be affordable until 2030. We all just opened a group OnlyFans. To summarize, SPX 4600 by noon tomorrow, I think the bulls are dead. I mean, we're almost at delta neutral right now. They barely were able to get a bounce back. There was almost no capitulation on the put side on the first drop. Clip this, but like everything since the meeting, like my whole big rant. Fuck, that was so long. I've been running my mouth for like half an hour now. One second. Are labor shortages the biggest negative effect on inflation? I would say wage increases due to labor shortages are the biggest effect on demand side inflation. Yeah. What does this mean for Upstart? It's probably pretty bad for them. One of my better FOMC meetings made money, but I could have made 5x more. What type of thinking is how I ended up with a soon-to-be ex-wife anyway? As long as you made some money, man, be happy. I cut like almost a quarter of my puts on the first drop. So like right here. Then I cut my calls at a loss. So, I mean, I kept these puts open, which is good, but as long as you made a little bit of money, you did fine. So that means the bulls have to give up those positions. I mean, those are 0 DTEs. They look pretty dead. 19 minutes left in the trading day. They could try to roll the 50s over to tomorrow and bounce it back, but they're not in a good position closing the day here near delta neutral. I can tell you that much. BTU October 20th, 25 calls that are down 50%. I was thinking you're either doubling down or close and reposition. I think you targeted it a little too high. Yeah, BTU gets hit. The fuck? Okay, that was weird. Oh, shit. Fucking Tesla got hammered. Oh, well. Can't believe I got stopped out of that. That fucking sucks. Congratulations to everybody that overheld their Tesla. BTU. Hold on, I'm taking a look. Okay, BTU is actually not getting hit that hard. Broad commodities are only down 7 BPS today. You have 30 days till expiration. I do think your strike is a little ambitious, but it could be okay. I mean, BTU has some negative beta, but not enough to resist a big downturn in the market. So it may be intelligent to at least hedge the potential downside before the next strike is crossed, which I think is at like 23.50. Can you discuss the Tesla play getting stopped out and whether you go back in and expectations? I mean, I'll probably get back in it. 63. I might get in it here before the end of the day. It's a little chasey, but not too much. Yeah, I should have stuck with my gut on that one and just held. Oh well. This is a slightly worse entry than what I had before. Yeah, I don't think my PT expectations really change much here. Still mid PT at 61. Yeah, hold on. Maybe I'll wait till tomorrow, see if there's any kind of light recovery. Maybe that's stupid. Any data that could reverse this tomorrow? Probably not. I don't think there's anything positive coming out. Bank of England's rate decision is at 7 a.m. I don't think that's going to be a positive in any way. I think they're just expected to move up their rate to 5.5. We have some Philly stuff tomorrow in the pre-market. So Philly Fed. We have like week over week like jobless claims. Existing home sales after market open tomorrow. That could have some effect. Japan's inflation rate and bank decision tomorrow night could have a very big effect. So I don't think too much of the US side data through the intraday tomorrow is going to be driving much. And positionally, you know, bulls are destroyed here. Interesting. I think we must stay on top. The last 30 minutes showcase the in-depth knowledge people really underestimate you for. I appreciate it, man. Cheers to 2 years. Thank you so much, Lentil Burrito. Glad to have you, man. Dropped a like. I was able to make 1.5K today. Stops her friend. Nice. I'm glad to see some people are walking out of this with a little bit of money. I mean, the neutral positioning, even if you just held both sides, should have printed hard as fuck. Tup run chance canceled. You know, Tup's dropping here into the end of the day, but it still looks illiquid as fuck. So I might play with it a little bit longer. Fuck it, why not? Do you think Netflix could hit 350 by October 20th? Bold. Yeah, could. There might be support at 380, but yeah, it potentially. Knock knock, who's there? USD JPY at 150. Well, it moved up to 148.15. I don't think it'll move up to 150 until their inflation data and central bank decision at a minimum come out. 25 months, huh? Still not a single uni recipe. At least I made 1K today. Cheers. Nice, dude. That's another 20 months locked in. $40 months. How much is Dillionaire? Someone tell me. So if I understood you correctly, you expect a downtrend 25, so 40. There, that's way too cheap. You expect the downtrend to continue tomorrow? Yeah, I mean we're almost below delta neutral here for today. This is bearish as fuck. We might find some future support on 44.50 here at the end of the day, but this is not a bullish range, and Vega risk is high here. It's $299 a month. Okay, that's fairly priced. What happened in the last 30 minutes? Did you finally admit to having Jpow's personal shill sell line? I fucking knew it. Jpow murdered bullish hopes and dreams. Gaff, you should have been there. Watching him dance around like a matador, thrusting his spears into the bulls until they collapsed from exhaustion. All of it completely unintentional and due to just the fumbling of his own narrative. But still, a dance for the ages. How are they keeping VIX contained here? Well, they removed a lot of the downside Vega risk earlier today. We talked about that. But there's still a shitload of it at 4,400. I picked up a few more Tesla debit spreads. Maybe I'll get some more fills. Kind of seeing how far up this bounce goes. The problem with buying here is if it tests 66, I have to average down again, which fucking sucks, but whatever. I'd rather have the exposure than not have it. It was, and it was glorious. I can't wait to see a running of the bulls into the ground. Plus, there's a fine line between incompetence and accidental genius. If it was genius, it was definitely fucking accidental. Where do you see the VIX during a correction and a crash? Wait, really? Like, I don't fucking know. 40, 50, 60, 70, 80? It's so fucking over short right now that if we corrected hard, we probably would get a crash, or at least a big fucking squeeze on short vol. So I would say that like 50, 60 is probably not impossible. Beyond that, it's kind of just, it just depends on how fucked everyone is, but... Good news, bad news. Which do you want first? Both. What happens when I get flagged as PDT? Can I move money to my account? Yeah, if you bring the balance up to 25,000, it gets rid of it. Who was that asked if we should buy TUP around 130? I don't know. How are the GME tips looking now? Shitty. I mean, reg show inclusion last night probably means that GME won't run, right? We already talked about this earlier. XRT on reg show, GME no runny. And it always goes on reg show at the last fucking possible second. Dumb XRT, yeah. Because once it's on XRT, they can just short, like, once XRT's on reg show, they can just synthetically short the fuck out of everything for another, like, at least another month. Any reason why they would put XRT on reg show? It changes the auditing process for the ETF. So then they can overload the ETF with synthetic shorts without it being an issue with the audit. The audit goes to like an archaic SEC audit system that doesn't that wasn't built or designed for ETFs. That's the only advantage I've ever been able to find. There may be other ones that I don't know of, but yeah, buys them about a month. It also lets them go massively over short the position. Whatever position they want, right? I mean, a lot of XRT took big hits this quarter, so I'm sure they want to try to get out of their long shorts over as much time as they can get. I know like Dollar Tree, Macy's, GME, like a lot of the big retail components in XRT took fat dumps this month. That should mean that the ETF FTD period is a little higher. And the following ETF FTD period should be very high. So November, beginning of November. Man, these talks about reg show and ETF audits is bringing me back. I never thought I'd have to talk about it again. I was hoping I would have sold all my GME by now. CNS says what? You know exactly what it fucking says, Gaff. RSP only down by 35 points. Someone's margin's about to get taken out back. Well, if VIX closes today under 15 and SPX has less than a 1 sigma move, the overnight margin requirement increase isn't going to be too substantial. No, Spirit of Halloween makes money. You can't buy calls on it. I think it's private. Good chances Jimmy goes lower than 17 in the next month now. It should have some price improvement. Ooh, fuck. Oh, this is so bearish. I love it. How much is NQ down today? I haven't even looked. 136 BPS? Fuck yeah. Let's go. Delta neutral before close would be the fucking tits. I think we're there. It's 10, what's delta neutral? 103, 4403, 4403, 83? Yeah, we're under delta neutral now. I just want everyone to just watch the end of the day and how accurate my little box is. Look at that shit. I have a tight box, is what I've got. We just filled up all of the Baratory. Thanks, Lit Spaceman. What's below Baratory? The Bear Cave. TM. Up 667 today. Thanks, dude. You're welcome, man. Congratulations. How much you're up on your longer dated SPX puts right now? That's not too crazy. I have my short straddle leg, like what's left of it is gonna toe ring gang here at the end of the day. And then I've got some 4450 and 25p in the money. My October 4400 are up. VIX hasn't moved up much though, so my Vega positioning isn't really killing it. And most of that's still a bit underwater. And my bear put My bear put spreads. Well, one of my bear put spreads is fully in the money, but my other one is 4,300, 4150. So that one's not in the money yet. And it's also old. It's kind of an old position, so it's still underwater a bit. Ding ding. The day is done. All right, so I mean, well, we've got a big fucking drop down, closing the day below delta neutral by about $1. Vega risk still very much compounded at 4,400. Continued move below 4,400, which is now the more highly probable outcome. We'll see an increase in volatility if we don't already see that increase occur in the overnight session. RSP down today, about 46 basis points. VIX correlation is starting to fall off with futures, which is historically, like VIX correlation with the contract in front is starting to fall off, which means that we're moving, VIX spot is moving slightly towards backwardation. That can increase, but it hasn't yet. Yields mostly up across the board. The 10 showing some, the 10 and 5 year showing some improvement today, but the 20 and 30 still contained. I don't know what the fuck that is. Why is that Tesla? That shouldn't be Tesla. Correlation tightened up today with the 1 month correlation surging back ahead of the 3 month correlation. That's significant. So we should start to see more of a, as that correlation picks up, we should see more and more vol flow back into indexes. I think we're now getting close to August's peak for correlation. Then, you know, beyond that, we start to move into tests like the May or maybe even March highs for that. Broad commodities only down 7 BPS today, so not bad considering the fall off in the market. Oil down, closing the day under 80 or 90 for futures. ES down 100 BPS, NQ down 155. Russell 2000 down 107, and the Dow down 26. Dixie closed the day up 17 BPS. Euro and pound down. Remember that the Bank of England's rate decision is in the morning. If they do choose to move forward with a 0.25 rate hike, that should bolster the pound a little bit in the overnight session. BTC and ETH also down. Oof. And futures don't appear to be stopping either. So yeah, this none of this looks good. I would say that a failure here opens up a correction to SPX like 4350, possibly even 4300 level. I think that's it. I clipped my post FOMC discussion. I'll try to get that edited and up for you guys so you can listen to it again or whatever you wanted to do with it. Thank you all so much. I hope everybody has a great night, and I will see you bright and early tomorrow morning. Have a good one, everybody.